was published on the website not too long ago. And thereafter, we will sort of follow the presentation with Q&A. Just some housekeeping. If you'd like to ask a question, please post it in the Q&A tab. Alternatively, you can raise your hand and we can take questions at the end of the meeting. Another point to note, so I'm aware that there may be load shedding that could potentially affect our connection with the management team. So if it does, please bear with us and we will sort of resume if there is any interruption. If not, we will continue. Amelia, good morning, and over to you for the presentation.
Good morning, Mahir, and thank you very much. Good morning, everybody, and welcome to our pre-close presentation ahead of the close period that we go in on Thursday, on the 1st of December. Welcome to everybody on the call, everybody that are here with me in the room, and thank you, Mahir and Fayad from Absa Capital for hosting today's presentation. As you said, today, together with Jose, we'll address any questions at the end of the presentation, and you can add your questions to the chat in the Teams platform. Can I continue?
Yeah, God bless you, my dear friend. Where are you?
Can I just ask that everybody put on mute? Thank you. So earlier in the last week, I read some market commentary that some of the very highly rated market commentators were talking about the transparency and disclosure of the REIT industry and how important it is that we give the information that is clear, easy to understand, and have everything that everybody needs. They also went ahead to say that we use ESG reporting as obfuscation to kind of disguise the numbers. And that got me thinking. It made me think about how do we report so that we have clear numbers, clear initiatives, and clarity on all the things that we do for all our stakeholders. Because we don't get up in the morning just to come and make money. We get up in the morning to do many things, to make a difference. So I'm really going to try today to make sure that we try and present metrics as clear as possible, but also that we will be presenting our sustainability metrics and the good that we do, because those things are all important. And I think it is right that we make sure we can share all of those with the market. So this year we faced some varying complexities. We've tried to reposition the business and to excel in the current environment. Our intention for 2022 was clear: to continue with our commitment of future-proofing our business, to remain ensuring that we drive value and positive recovery. If we look at our results of the third quarter, we are pleased with our financial and operational performance in the period, and it continues to show encouraging improvement in all our key indicators, consistent with previous quarters this year, and we show the growth against 2019 because that was the last year of normality that we had. It is important to know that with where the environment finds at the moment, with rising costs, municipal charges that are really taking a big chunk out of our cost, the cost of diesel so that we can keep our environments running, it does mean that the improvement that we see in the top line does not automatically go to the bottom line immediately, because we do sit with those jaws that detract from that, and it will take some time before we see the positive top line growth also flow through in what we see in our bottom line numbers. The value created in our business is driven and measured through our strategic value drivers, and I will unpack the details of the portfolio performance in the presentation. But let me just share a few highlights with you. Firstly, We've seen our foot count grow by 29.6% compared to 2021 and 9.8% compared to 2019. Our annualized trading density recorded double-digit growth of 18.6% ahead of 2021 and 12.1% ahead of 2019, with some strong retail occupancy. Our transformation initiatives remain on track. We've improved the loan to value of our business to 24.4% after the refinance that we did in October. I'll talk about that a little bit later. We continue to have a strong balance sheet and we have sufficient liquidity to meet all our operational needs. From an environmental perspective, we've maintained focus on driving sustainability targets with continued progress across all our pillars. If we move and look into a little bit more detail into the foot count trends, the portfolio continues to attract visitors, as can be seen in the quarterly graph. All 3 quarters in 2022 have now surpassed 2019 levels, with an average monthly foot count in the 9 months of this year 6.2% greater than the average monthly foot count for the full year in 2019. And with the festive period upon us in a few days, we anticipate really great performance for the 2022 festive period. We've just been through the Black Friday weekend. Foot count on Black Friday was up 15% in our portfolio versus 2021. It remained on the day 20% below 2019 levels. However, there are 2 factors that we have to remember. Payday was also on the 25th, and many people only get paid by the end of that day. So what we saw was Black Friday stretching into a whole weekend, with the numbers on Saturday being almost equally as good as the numbers on Friday. At Sandton City, we saw the numbers up 15% on 2021, which is the same as in our overall portfolio, but only 9% below 2019, and then saw that huge pickup on the weekend. So on a normal weekend, end of the month weekend, we would normally get around 80,000 people in Sandton on a day. We had 120,000 people on Black Friday and 110,000 people on Saturday. So you can see how that was almost 50% more people here than what we would get on a normal busy weekend. There are also some retailers that started trading at midnight, and they saw an influx of early bird shoppers. The highest levels of customers were seen around 12 to 4, and you can see that is people shopping between lunch breaks and after work. This may also indicate that more people are back in the offices. We saw some overall in our portfolio, as I say on the Saturday, we saw the foot count for that being 18% up overall. And we're really confident that when we start getting the turnover numbers in the next few days, that we will see how that positively contributed to our portfolio. Foot count growth over the period was driven by various experiential initiatives that dominate in the LTD precincts, and we continue to demonstrate unrivaled creativity. We are proud of the recognition we received at this year's Footprint Marketing Awards, where the LTD portfolio won a total of 29 awards for retail marketing excellence. And that's really a testimony of the thought leadership capabilities and the impact that the malls continue to make in their respective communities. My favorite thing to speak about is always super regionals, and are they back? And you would have heard me say many times, super regionals are alive and well. They've come back strong after being hardest hit during the last 3 years, almost 3 years now. And they have achieved double-digit growth for the last 2 quarters of the year in comparison with 2019. Sandton City's foot count is up 13.8% in the 3rd quarter ahead of 2019, and the monthly average is up 9.2% for the 9 months ending September compared to the same period in 2019 and 5.3% ahead of the full year of 2019. Eastgate, similarly, the foot count is up 17% in the third quarter ahead of 2019, and the monthly average up 8.6% for the last 9 months compared to 2019. So people are coming, they stay, and they spend. Let's move on to the hospitality sector. The sector continues to gain traction, with Sand and Sun ahead of 2019 levels in occupancy and RevPAR. However, the Garden Court and Sand and Towers continue to trade slightly below. Sand and Sun achieved an occupancy of 81.2% for the month of October, taking its average occupancy for the year to 74%. It was 66.8% in 2019. The Garden Court achieved an occupancy of 70.5% for October, and resulting in the average occupancy for the year being 50%. Sand and Towers, which opened for trade in August 2022, that's the old Intercontinental, achieved solid occupancies in the opening month, and month on month, we see about a 3% tick up in that occupancy. Weekend occupancies continue to improve ahead of weekdays, indicating that local corporate travel has still not returned to pre-pandemic levels, and that presents really an opportunity for us for 2023. Year to date, the Sandton Convention Centre has been exceptionally busy. They've had 165 events compared to 41 events in the same period in 2021. And you just have to try to turn to our office out of the road in the morning to see how many people are actually back at these conventions. If we look at the annual trading density numbers, and we see in the graph that we do a comparison between the portfolio performance in the CLER benchmark and our portfolio performance for both annualized trading density and annualized trading density growth. Our portfolio continues to perform much ahead of the benchmark, and although we've seen the two super regionals having been impacted, they have shown very, very strong recovery. In 2019, the portfolio annualized trading density growth were tracking below CPI, indicating pressure on the retail sector already. This pressure was exacerbated then by the lockdown restrictions, but we see that in 2022, the annualized trading density growth tracked well ahead of CPI, reflecting some real growth, and the annualized trading density is above 2019 levels. In 2022, in September 2022, the portfolio achieved 18.6% ahead of 2021 and 12.1% ahead of 2019. The top 5 retail categories with the most improved trading density performance continues to include luxury brands, continue to really perform exceptionally well for us. Technology at 44%, luggage and leatherware that has come back, people are traveling again. Supermarket and grocers at 18.8%, and health, beauty and wellness at 9%. The portfolio has generated 14.65 billion in turnover to the end of September. That is 17% more than 2019 and 25% more than last year. You remember that I would have said that we also look at turnover growth, but because that gives you the absolute numbers. And whilst we have reintroduced trading density as a measure to look at because there's more stability in the base now, it is good to see that for the year ending September, we've generated some 20 billion of turnover in our whole portfolio, which is 22% up on 2019 and 14% up on 22% up on 2021 and 13.9% up on 2019. And that really talks to how the whole portfolio's turnover contributed to the densities going up. Just before we went into COVID, we were very excited because we were going to get to achieving an annualized trading density at Sandton of 60,000 Rand per annum. That is 5,000 Rand per month. And That is something that haven't been seen in the South African market, certainly in super regionals. Well, we then had COVID happen, and that sort of went away. What is so encouraging is at the moment is that Sandton's trading density is over 70,000 rand, over 6,000 rand a square meter. So way above what we have seen in pre-COVID levels, and just an indication of an extraordinary asset that continues to outperform on all levels. Let's look at our occupancies. At the end of 2022, the portfolio occupancy is 93.2%, with future pre-lets improving the occupancy to 93.9%. If we exclude Melrose Arch, the portfolio occupancy is 95.3%, and with the pre-lets, that improves to 96.1%. Everybody worries about office vacancies. Our office vacancy only makes up 5.6% of our total portfolio GLA, whilst the retail vacancy is 1.2%. So whilst it feels like the office vacancy is high, it makes up a small portion of the overall portfolio. The retail portfolio's occupancy are now at 98%. At the end of October, it was at 97.2% at the end of June. And there are a further 0.3% of pre-lets that has already been done. We've seen a few of those stores open in the last few days ahead of Black Friday, and some more will open ahead of the festive season. That remains well ahead of the MSCI retail benchmark of 94.2%. Our two super regionals, Sandton at 98.7% and Eastgate at 96.1%, it brings that combined occupancy to 97.5%, and that is also ahead of the MSCI super regional benchmark for the second quarter of 93.7%. As I said, the office portfolio remains under pressure. There's no doubt about that. But we've seen the occupancies improve over this time. I have told you during our results presentation in July that with the sale of the Standard Bank building, which was 100% let, our occupancy will come down. So it's gone to 78.8%. But if we had compared that to the same number in June, it would have been 76.4%, which means we did have an improvement in our occupancies. Load shedding, in fact, is assisting with our office occupancies because not everybody has full generation capacities at home, and they can come work in the office and have full power here. We continue to remain very focused on leasing, and our teams with some great pre-letting will see our office occupancy improve to over 80%, and that will see some great new tenants move into specifically Nelson Mandela Square, taking up a large part of the space. If I move on to leasing, our leasing teams have been very busy. LTD concluded a total of 281 leases in the period, and that includes 102 new deals and 179 renewals. This takes the leasing to date to over 68,000 square meters. That is a large regional shopping center on its own. The reversion for the retail sector is down to -9% at the end of October. That improved from the ghastly 26.4%, which we were also worried about in December. The reversion for the office sector remained negative at 26% because we focus on retention. We can't let these tenants go, and we continue to strive to keep them here and see them through this period. We have experienced a steady improvement in the reversion rate of the portfolio, and as you can see in the retail sector. The reducing reversions have been supported by the improved trading performance. But as I said earlier, it takes time, and we hope that by 2023, we'll see the reversions turning positive. The retention rate based on the concluded leases to October is tracking at 78%. And that's as a result of a few large office leases at Melrose Arch that were not renewed. If we exclude the Melrose Arch number, the retention rate improves to 86.4%. When we came out of the pandemic, we had a clear message to our teams, and that is that we have to keep our malls and our offices full. And it's great to see that we could keep these vacancies down, our occupancies at some of the highest levels in our retail portfolio that we've seen before. There's nothing more depressing than papered up windows and vacancies everywhere in an environment. And it's wonderful to see where tenants are trading, new shops are fitting out, and you'll continue to see that in our business. We really strive to get the right tenant mix and provide the optimal shopping selection for customers. We are so excited about the first in-country tenants like NMA Store and the first standalone H&M home in our portfolio that opened in the last week. In this boardroom over the last few months, we've sat with many international tenants to come into South Africa that are not here at the moment, or those that are here that want to make their stores bigger. And that really talks to quality trading environments, their confidence in the customer that we have here and the spend that they can attract in these stores. We really look forward to some new tenants that will be opening in the next few weeks, and really look forward to a great festive season where customers will be spoiled for choice and really anything that they would want to come to our malls and love being here. If we move on to our debt refinancing, our term debt expiry of 850 million rand has been refinanced successfully for a further 5 years and now expires in October 2027. We have taken on additional interest rate swaps. Post the refinance, our loan to value ratio is 24.4%, with an average debt duration of 3.6% and a hedge duration of 3.6 years, and a hedge duration of 4.1 years. Our blended all-in cost of finance at current JIBAR rates is now 8.83%. Our stakeholders trust us to operate and grow our business in a responsible manner. It is therefore of utmost importance that we incorporate all environmental, social, and governance pillars in ensuring that we achieve this. Our ESG strategic framework aims to integrate the ESG perspective for the short to medium and longer term that informs corporate decision-making. Key commitments that we've made is that we ensure a common understanding of ESG and our appetite for integrated thinking and strategic integration. We are adopting authentic sustainable thinking in our business, and we have established ESG qualitative and quantitative measures, as well as identifying reporting and disclosure metrics. We've worked with the SREIT industry to drive the establishment of the ESG framework, and that will be out in the market shortly. And we hope that as an industry, we can then have metrics that are of good quality and that are transparent, and we will all report on the same. What is so important in this is that for us, this has also become something with a commercial benefit. And as we go through our net zero journey and our net zero initiatives, these initiatives contribute to the commercial success of our business. In other words, they also bring the rands and cents, and that is as important for us. We have been unwavering in pursuing our net zero targets and have continued to progress this effort in Q3. I want to make clear that our net zero targets are for scope 1 and scope 1 and scope 2 for us and our tenants. If we then look at the additional scopes that will be included in the ESG frameworks, those are things that we will pursue towards 2050, as they are slightly more difficult to get. They are outside of our control, but those things that are in our control that we can drive, that we can influence, we are unwavering in the bold commitments that we've made to that. If we look at waste, our net zero target are on track for 2022, with our portfolio diversion from landfill continuing to improve. We continue to drive all our waste initiatives, not only wet waste, resulting in an impressive 88% waste diversion rate at the end of September. A future benefit to the portfolio, and particularly our tenants, is the implementation of differential waste billing. This is now in place at Promenade and Midlands, and we will be rolling out to the rest of our portfolio by early 2023. Water has become such an important part of this journey. If you live in Joburg, in the northern suburbs, there have not been water in a large part of the households for 2.5 days now. So we are so aware of how important it is for us to track our water journey. We've done a detailed investigation into our HVAC systems, and that have identified many opportunities for us. This solution will be rolled out within our CapEx program in the next 3 to 5 years, and is absolutely there to benefit our business commercially as well. Rainwater harvesting opportunities and black water treatment facilities are being considered at all our properties, and these will be rolled out between 2022 and 2025. Health and safety remains a priority, and we will strictly adhere to the guidelines to reduce all possible risks. We continue to install water-saving devices such as aerators, water pressure control, and time taps. Our energy journey is an exciting one where we are reducing reliance on the national grid and using sustainable forms of energy that is critical for us. We talk about load shedding all the time. Our malls, the lights are always on, and we have been able to achieve that for our tenants. We've got 3 megawatts of solar that's been installed in our assets, and with Promenade Solar completed in June 22, we will see that our centre's carbon footprint offset by 2,300 tons each year. We have an additional 14 megawatts of installation planned. This includes a 4 megawatt and a 4.3 megawatt solar power at Midlands Mall and Eastgate respectively. The Promenade is to receive an additional 3.5 megawatt between 2023 and 24, and Sandton City and Boschebelo Mall is to receive a 1 megawatt solar PV plant each during 2023. Ongoing investigations for opportunities in energy wheeling have progressed well, and that we can expect to have in place in the second half of 2024. If we look at further achievements in our energy journey, we've met the requirement for energy performance certificate regulations ahead of the deadline that it was to be on the 8th of December. You would have seen on Friday that the government have now postponed that deadline by 3 years, but nonetheless, we are done with that. We have obtained a 6-star green rating for the interiors of our L2D new offices, and that is really part of our commitment to also make our place of work as well and as green as possible. We've conducted a biodiversity gap analysis to establish the improvement areas in that. And we have signed up with the SBTi for the setting of science-based targets, which we will have concluded when we release our results in February. What is also important is to understand the impact of diesel on our costs this year. We have spent an enormous amount on diesel because of the impact of the large amount of the continuous and frequent load shedding. We also understand that in December there will be more of that. So we will continue to keep the lights on in our malls and to make sure that we provide a place where people can come and shop safely. Our malls, Sandton City and Eastgate, received their platinum status again from our ratings agencies for security. So we'll continue to keep these environments as safe as we possibly can so that we could provide a festive season trading environments for our tenants that customers would love to come to. We've been supporting sustainable and inclusive economic growth within the communities in which we operate, as that is also important for all of us. We are committed to actively serving, investing in, and supporting our communities while recognizing the more significant stewardship role that our organization must and can play. We facilitate socioeconomic empowerment within these communities wherever practical or possible, and we have an active community engagement strategy to ensure that our social investment impact is meaningful. Gender-based violence remains a deep-rooted problem in South Africa, and in line with the Sustainable Development Goal number 5, which is to achieve gender-based equality and empower all women. On the 27th of August, we called on the support of the public to take a stand with your hand at Sandton City against this pandemic. We received a remarkable response where people came in their numbers to make a mark on our mural of handprints to show their solidarity in supporting the women of South Africa. In biodiversity, we continue to adopt best landscape management practices to protect the environment and public health and conserve natural resources, to reduce the impact of invasive species and improve biodiversity endemic plants. L2D supported environmental and environmental initiatives through donation, aligning that to our biodiversity strategy. As a response to the need for a safe space for students battling with electricity needed for studying, L2D and Sandton City have come together and responded with an interim solution where we provided a 500 square meter designated space with desks fitted out in the Sandton City's atrium, and that was made available to students who needed a quiet and safe space to study. The area had electricity, Wi-Fi, and security, and during any load shedding schedule, high school students and others were invited to use the space to study for the year-end exams. Following on our people strategy, we had the retirement of our human capital executive, Steph Goodman, and as part of our succession initiatives, we had Yongi Nteni assume the role as human capital executive from the 1st of November. With regards to transformation, we have made significant progress in the areas of employment equity, socioeconomic development, and enterprise and supplier development. And we have achieved all our initiatives to become a level 1 contributor in 2023. L2D has an unwavering commitment to gender diversity and inclusion. The current state of the industry reflects a very concerning view. We have therefore challenged industry leaders in the sector to not be overwhelmed by this, but do the one woman at a time challenged. And I've been watching in awe how there have been more women included and bold actions taken over the last few weeks. We have also signed the United Nations Women Empowerment Principles, Community of Companies, and as a signatory, we've committed to making a difference for gender equality and women's empowerment in the workplace, in the marketplace, and in our communities. The L2D people and our people in the malls have done an extraordinary job this year. Every day, thank you to all of you. I am really proud of you. We are also pleased to have announced the appointments of Nonhlanhla Maisela, Tumi Dlamini, and Pelisiwa Mtetwa last week as independent non-executive directors to our board. And post-appointment of these three directors, our board is now composed of 64% independent directors. From a gender diversity perspective, there are 55% women. And from a racial perspective, there is 55% Black directors. Black female directors now comprise 45% of our board. I'm grateful to our chairman, Nick Kritikos, and our whole board for the equal measures of challenge and support they continue to give to us. It keeps our business safe, it keeps your investment safe, and it keeps us inspired to do better every day. Earlier, I expressed that future-proofing our business remains our commitment and a way to ensure that we drive value and positive recovery. We are pleased with the performance that we have achieved this year, which continues to show encouraging improvement in key indicators. We remain focused as the leadership of this business on driving these positive outcomes to counter and address the challenges that we are presented with through various initiatives that we have in place. We drive our leasing very, very hard because that is the key to driving positive returns in our bottom line over time. And we continue to track the positive momentum in our business so that we can look after it for the long term. Gratitude is an act of care and contribution, and it is aligned to our values. Over the weekend, I read a piece that was written about Michelle Obama that was asked about her children and how they are doing. And she responded by saying that they are doing well, they are healthy, they are happy, they are integrated in their communities, and they connect with each other. And the piece looked into how amazing that was, that she spoke about the wellness of her children, not how well they have performed or their achievements at university or wherever they are. And that made me think about business and about South Africa and where we find ourselves in the property industry at the moment. What if we can look at the investments that you have made in our business, the shareholders' investments that have taken up a space in our business this year, the tenants that are trading in this environment, the service providers that we are employing, the people that work in our business. What if we can look at that as the way in which we were able to, with your support, keep the malls full, kept our occupancies high, and as a result of that, our tenants could keep on employing people, and that could create some downstream opportunities for employment in this country. In addition to that, we were able to keep a lot of people in our service provider teams employed. We have been able to keep our malls safe. And we have been, together with that, able to deliver financial returns that are better than the previous year. None of that would have been possible if it was not for the support of our investors, our shareholders, our analysts that are reporting on our business, and everybody, every stakeholder that contributes to what we do. I hope that when all of you reflect back on 2022, you would not only reflect back on the financial returns that were delivered, but on the difference that you were able to make by investing in our business. Your clients, your customers made sure that we could achieve all the things that we were able to achieve. I wish you all a festive season where you can spend time with your family and with your friends and rest and recuperate to come back in 2023 with some renewed energy, for all of us to together tackle the challenges that lie ahead of us. We have all learned that we can do hard things, and I have no doubt that 2023 will be hard as well. But we know that we've learned in the last few years that we can do it if we hold hands and step together forward. Thank you. I'll now take some questions.
Thank you, Amelia. Just a reminder to participants, if you would like to ask a question, please post it in the Q&A tab or raise your hand and you can actually ask the question directly. I see there is a question that has already come through, but maybe if I can just kick it off from my side. The observation, I mean, based on the figures that you've reported, speaks to an improving trend. If I look at occupancies, rent renewals, so trading densities, footfall, etc. So the question that I have is maybe you can shed some light on how this has impacted occupancy cost ratios for tenants and just your view on the sustainability of rentals at this point. Do you think we have sort of reached the trough in terms of sort of base rentals, or what is your expectation, at least looking forward?
I think we have said for a number of years that it is our aim to create a long-term sustainable business where we can have high occupancies and tenants that can trade to be able to afford their rental over the long term. So we've seen in the last 2 years some significant reset in those rental levels, and that was necessary. Otherwise, we would not have been able to keep these tenants here and keep them in play. As I said earlier, we expect to see in 2023 our reversions getting to equal, slightly positive. That doesn't mean that every reversion is positive. It means overall, the improvement that we've seen in the trading environment have enough of it filtering through those tenants that are renewing. So have we seen the bottom of this? I don't know. There's a lot of uncertainty in the market. We don't know how trading is going to be in December. Have we seen it improve? Absolutely. Every day, it looks better than it did yesterday. Every renewal is better than what the previous one was. And you can see it as our renewal numbers have come out of that 26 and high 20% up to the single digits. And we will continue to do whatever it takes to drive us. With the increase in cost, you will see when we unpack our results in February that it is a fact, it's a reality of the things that we have to deal with. Labor costs are up, electricity is up, rates are up, everything is up. And we have a couple of years ago introduced the concept of the CCO ratio versus rent to sales ratio. Because I think to just look at rental as a measure of a tenant's profitability is not the right thing to do anymore. We introduced the CCO ratio for that reason. So to look at the total cost of occupancy, because there are all these other factors that impact how much rental we can charge. But I think it is that balance between keeping people here, bringing new tenants in that will drive the best customer experience, and continue to delivering a distribution for our shareholders.
Thank you, Amelia. I'm just going to run through the questions that have come through thus far. There's a question from Ridwan, in essence asking whether or not, if you can give an update on guidance previously provided 3 to 8%, and whether or not you can refine it further or define it further, given that there's 1 month left to financial year end.
As Ridwan says, we gave a guidance of 3 to 8% when we presented our results in August. If anything changes and we have to update that before our results come out, we will do so.
Thank you, Amelia. There's a question from Londiwe. At 6,000 Rand per square meter, is Sandton City's trading density now the highest ever seen in South Africa?
I think at 6,000 Rand a square meter, it's certainly the highest super regional and regional. Some of the very small trading environments might well produce that. But if you look at the benchmark of the MSCI benchmark for regionals and super regionals, that trading density is anywhere between 33 and 36, which is just less than 3,000 Rand a square meter. So yes, it is the highest that certainly we have ever seen.
Thank you. There's a question from Lukman. In your view, what is the appeal or investment case of large malls in South Africa over the next few years? Rental reversions are negative, costs are higher, and rental streams have not been more positive than their smaller counterparts. Maybe just a comment on that.
I think it is important that we don't just compare any large mall to another large mall. It's all about the specific asset. We spend a lot of time making sure that the assets that we have are well managed, they have a great tenant mix, and they trade well. I don't believe particularly that there is space for new super regionals in South Africa right now. We have a lot of retail space. We have to use what we have in the best possible way and make them work. We also have to make sure that tenants don't continue to open everywhere because they proliferate their own sales, and rather have it together where we can provide an overall customer experience. Rental reversions, as I said, is coming positive. Costs are higher anyway, whether you're on a super regional or whether you're on a smaller place. And the recovery of super regionals have just been better than we've seen everywhere else. And I don't think with the trading densities that we see, there's any denying of that. Super regionals have a place in the retail industry because that's the place where you can get everything you need. The interconnectedness of human behavior wants people to be together. They want people to go together to places and do things. That's the opportunity that we are given by super regionals, is to offer that to our customers.
Thank you, Amelia. There's a question from Gift. Are you seeing benefits from the parking space taken by second-hand car sales in Eastgate?
I think we use that opportunity to generate some additional income from our parking. So that certainly is a benefit, that parking is not always full every day. You know, we provide a lot of parking in our malls and people want to park in the same space every time. So that additional parking spaces, it's a temporary initiative, but it certainly has seen us create some income through that.
Thank you, Amelia. A couple of questions from my side. And I mean, these topics were discussed at your interim results. I'm just wondering whether you can provide an update. The first one is the outcome of the lease negotiation with Woolworths. So has that been concluded? What is the expected financial outcome for the fund?
We've had some really great negotiation outcome with Woolworths. We are really nearly at the end of that, and we will provide an update of where that finally landed in our February results. But we are pleased with where we got to, and Woolworths are important retailer for us. Sandton City is an extremely important store for them. It's 14,000 square meters. It creates great turnover for them. So it was important for them, and it's important for us, and that's what you will see reflected in the final outcome.
Okay. I see Nazim has actually asked the same question, so already answered. Another point, again, coming on from the interim results is the Sandton City rates dispute. Is there any update on that, or do you have any comments that you can provide?
Unfortunately, the chairman of the VBA, the Valuation Appeals Board, got very ill, so the appeal had to be postponed. It is now taking place on the 5th of December, and we hope to have an outcome of that early in the new year. After the appeals board sit, I don't think we can expect an outcome on that day, but hopefully, fingers crossed, by the time we come to results, we would have successfully concluded this matter.
Thank you. Amelia, a question from my side. Again, just going back to the retail update that you provided. Now, what we've seen in the retail sector is that there's been a fair amount of consolidation. Do you have any comments with regards to how this has sort of panned out in terms of your lease negotiations with certain of these large listed retailers? I mean, have they viewed this as an opportunity to sort of rebase rentals across the portfolio? Because I mean, arguably you can say that their bargaining power has actually increased as a consequence of these changes that we're seeing. Maybe just provide some insight in terms of how these negotiations have tracked due to the activity we've seen.
Look, lease negotiations is one that really happens on a case-by-case basis, especially in some of our bigger malls. For example, Sandton, you know, each negotiation takes into account what the specific retailer has traded in that space. And whilst we've seen some consolidation and more of the listed retailers owning some of the brands, it gave us an opportunity to also push them hard in terms of what they have been fitting out in these malls. If you get an opportunity, come and see the likes of the new at-home store at Sandton City. It's extraordinary. It can hold up with any home store in the world. And I have told that to the CEO. And you would see the new standalone H&M that just opened here. It is really great stores that we have here. So we value our space. We see what that space is worth and what tenant we want to have in that space. And we have options in what we can put in there. So yes, we've seen that consolidation. We've seen some of them taking up more space. But they are good retailers in South Africa. They bring us good tenants. And we have really been striving to get the best for both of us. It's something that we have learned during the work that we've done as a property industry group, is in the end, we only win if both parties win. There can't just be one that wins and the landlord has to lose all the time. It just can't work for anyone.
Thank you, Amelia. Two questions from Yesh. The first one, if you can provide an indication of the escalations that you've achieved or agreed on new and renewed leases post your interim results. And then the second part of this question is, what would the proceeds from the Standard Bank offer sale been used for? Or what have they been used for?
Escalations are also something that is done on a case-by-case basis. We've seen escalations track between 5 to 6% or 6 to 7% in our renewals. So escalations has where inflation is with at the moment. It's probably not tracking that, but we haven't seen escalations pare back significantly below 6%. It's that first year's rental that becomes the key negotiating piece. And then from there, we also think about maybe changing the lease periods in times where we see it's difficult to bake in now a longer term solution. The proceeds of the Standard Bank sale have been used to reduce our debt, and you would see that in our LTV that's now below 25% again. And we I see the other question is around planning of selling more of the local assets that are non-core. So we have always said non-core assets for us are assets that are not connected to our retail. So standalone offices, we have very few of them left. And assets where we are not the manager. We like to be in control of the assets that we manage. That's how we can apply our philosophy. And so those are assets that will continue to remain non-core for us. We will sell assets if we get the right price. We will not sell assets at any cost. So this is not an opportunity for us to get rid of something quickly. We will sell it like we have the Standard Bank building at the market value that we have been holding it on our books.
Thank you, Amelia. Just a follow-on question from my side, just with regards to your balance sheet capacity that you have. Maybe a comment on capital allocation going forward, given that your share price is still trading below or at a discount to NAV. I mean, what's your view on share buybacks as a capital allocation sort of decision? And then the other one is in terms of investing in the current portfolio or looking for opportunities sort of outside of your portfolio. Maybe just some comments on your view on capital allocation and how you'll be applying your capital.
So what we've said in terms of our capital allocation is that we will use the balance sheet that we have to look after the assets that we have in the best possible way. Part of that is deploying capital in the initiatives that provides us commercial benefits, but also aids our ESG initiatives. So our solar initiatives, as well as our water initiatives, those are things that we are actively allocating good capital to. It gives us good returns, and it drives performance for us, not only by creating new power or saving us costs, but by also giving us some good investment returns. We have said earlier that in terms of our buybacks, we have we did some buybacks this year. We put that on hold pending the decisions around these capital allocations plans. We continue to evaluate which of the capital allocation decisions will give us the best returns.
Thank you, Amelia. A question from Jared. Do you feel it's possible for LTD to get back to pre-COVID level of dips in the medium term?
I have given some, as I said, we will tell you if anything changes before our next results. And if we then look forward, we will provide some guidance on where we see the performance going. I think it is important to remember that when we delivered 60 cents in this business, we didn't have a cent of debt. So just remember that in doing your assessment. But we continue to work creating a sustainable business that will continue to grow. These are not speedboats that we manage. These are large, big vessels. They go forward every day, but they don't just go forward with the speed of a speedboat.
Amelia, just another question from my side with regards to property valuations. Yeah, maybe if you can provide some insight in terms of what your expectation is on a forward-looking basis in terms of valuations. We've seen a strong operational recovery, which I suppose would be a positive outcome from a valuation perspective, but there's obviously the risk that discount rates and cap rates move out. So maybe just your sense of how those two will sort of play out in the ultimate valuation outcome.
I think what we will see or what we are expecting from a valuation outcome is some valuations that there are not much change, because we see good operational recovery, but we also see a worsening environment. And those two things at large probably cancels each other out. Our valuations are being finalized at the moment, and those will be ready for our year end. So we also, as the market would know, JLL has closed their valuation practice in South Africa. So many of us had to change valuers, and I'm thankful for the team that have, in a very short space of time, picked up the valuations of these large assets. So it's a fresh pair of eyes that are on it, and we look forward to getting the outcomes of these valuations.
Thank you. I am cognizant of time, so I'll ask one last question. There are no further questions that have come through on the chat before we close off. And I just wanted to get a sense of whether you have any comment on the corporate structure. I mean, is there any further visibility or commentary you can provide with regards to the sort of corporate structure of this business going forward?
We have been really, really focused on recovering these assets to the best possible way that we can, in providing the outcomes for our portfolio at large. Whether we only have a portion of the assets, the other assets is on the Liberty balance sheet. So for both those owners, been trying to run the best operational business that we possibly can. The rest, that will be up to the shareholders of this business. We will continue to do what we can to achieve the best possible outcomes.
Thank you for that, Amelia. Amelia, maybe I'll just hand over to you again for any closing comments or remarks before we end the meeting.
Thanks, Mahir. Always insightful, your questions. Thank you for everyone for your questions. If you have any further questions, welcome to send them through to Terria or Sementri. We're always happy to answer those. Your questions help us to think about things and to continue to want to do a little bit better and be inspired to deliver for our shareholders every day. So thank you, and see you at the end of February.
Thank you very much. I think we'll close the meeting there.
Thank you.
Bye-bye.